When gold moves $300 in 2 weeks, you need to ask whether you're witnessing a structural shift or a liquidity-driven squeeze that will reverse. When silver jumps 8% in 72 hours, while the dollar index drops below 90, you need to understand what's driving capital flows and whether those flows are sustainable. And when headlines scream that the dollar is dead and gold just hit 5,000, you need to separate monetary theater from actual capital allocation reality. Before we break down what's really happening in gold and silver markets right now, make sure you're subscribed and hit the bell icon so you don't miss future analysis. And if you find this breakdown useful, hit the like button to help more investors find this content. Let's start with what actually happened. Gold didn't hit $5,000. As of mid-February 2026, spot gold is trading in the $2,800 to $2,900 range depending on the session. That's a significant move from the $1,800 level we saw in late 2023. Representing roughly a 55% gain in just over 2 years. That's a compound annual return of approximately 24%, which outpaces the S&P 500's average historical return and significantly exceeds bond yields during the same period. Silver moved from roughly $19 per ounce in late 2023 to around $32 today, a gain of approximately 68% over the same time frame. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, compressed from 95 to 1 down to approximately 90 to 1, suggesting silver outperformed gold on a percentage basis, but still remains historically undervalued relative to its long-term average ratio of 60 to 1. So if gold isn't at 5,000, why are investors discussing structural dollar failure and monetary reset scenarios? Because the drivers behind gold's move from 1,800 to 2,900 are the same structural forces that could eventually push it toward 4,000, 5,000, or higher over the next decade. Understanding those drivers matters more than reacting to sensational price targets. The Federal Reserve's balance sheet remains above $7 trillion, roughly double its pre-pandemic level. That expansion injected unprecedented liquidity into the system, increasing the monetary base and diluting each dollar's purchasing power relative to scarce hard assets. When central banks create money faster than the economy produces real goods and services, the result is monetary debasement, and gold responds by repricing upward in nominal terms. U.S. federal debt now exceeds $36 trillion, with annual deficits consistently running above $1 trillion even during periods of economic expansion. Debt to GDP ratios above 120% create fiscal constraints that limit the government's ability to raise real interest rates without triggering unsustainable debt servicing costs. This dynamic traps monetary policy in a low-rate, high-inflation environment, which is structurally favorable for gold and silver as inflation hedges. Real yields, calculated as nominal treasury yields minus inflation, have been negative or near zero for extended periods. When the 10-year treasury yields 3.8% but actual consumer price inflation runs at 4.2%, real yields are negative 40 basis points. Holding bonds in that environment guarantees a loss of purchasing power, making gold's zero nominal yield suddenly attractive because it preserves capital against inflation without counterparty risk. This shift in opportunity cost is critical. Gold doesn't pay dividends or interest, so when real yields are positive 4%, holding gold means forfeiting that return. But when real yields turn negative, gold outperforms because it doesn't lose purchasing power the way cash and bonds do. Central bank demand provides another structural pillar. Central banks globally added over 1,000 metric tons of gold to reserves in 2023 and similar volumes in 2024 and 2025. China, Russia, Turkey, India, and Poland have been consistent buyers, diversifying away from dollar-denominated assets amid geopolitical tensions and concerns about dollar weaponization through sanctions. When central banks accumulate gold, they remove supply from the market permanently, tightening available inventory and supporting long-term price floors. This isn't speculative buying that reverses quickly. This is sovereign balance sheet restructuring, which signals a multi-decade trend. Geopolitical fragmentation accelerates this process. Trade wars, tariff escalations, supply chain reshoring, and military tensions between major powers increase uncertainty and reduce confidence in fiat currency stability. Gold becomes the neutral reserve asset that doesn't depend on any single government's fiscal discipline or geopolitical alignment. Now let's talk about what this means for capital allocation and long-term positioning. If you're holding a portfolio weighted heavily in equities and bonds, you're implicitly betting that nominal returns will outpace inflation and that central banks can engineer soft landings without triggering recessions or renewed inflation spikes. That's a reasonable bet during periods of stable monetary policy and productivity growth. But when fiscal deficits are structural, debt servicing costs consume 20% of tax revenue, and central banks are politically constrained from raising rates meaningfully. That bet becomes riskier. Gold and silver function as portfolio insurance against that tail risk. A 5 to 15% allocation doesn't require you to believe the dollar will collapse tomorrow. It simply acknowledges that monetary instability, inflation persistence, and geopolitical disorder create scenarios where hard assets outperform financial assets. Let's model this with realistic numbers. Assume you have a $1 million portfolio. You allocate 10%, or $100,000, to physical gold and silver at current prices. Gold sits at $2,900 per ounce, so you acquire roughly 34 ounces. Silver sits at $32 per ounce, so you acquire roughly 1,500 ounces if you split the allocation evenly. Over the next 5 years, assume gold appreciates to $4,000 per ounce, a 38% gain, and silver moves to $50 per ounce, a 56% gain. Your gold position grows from $50,000 to approximately $69,000. Your silver position grows from $50,000 to approximately $78,000. Your total metals allocation increases from $100,000 to $147,000, a 47% return. Meanwhile, if equities return 8% annually over the same period, your $900,000 stock and bond allocation grows to roughly $1.32 million. Your total portfolio value becomes $1.47 million, and your metals allocation now represents 10% of $1.47 million, or roughly $147,000, maintaining proportional balance while providing downside protection if equity markets stumble. That's the compounding benefit of holding uncorrelated assets that perform well during different macro regimes. But here's where psychological discipline matters. Gold and silver don't move in straight lines. Gold pulled back from its peak of $2,100 in 2020 to $1,800 in 2023 before rallying to $2,900 today. Silver dropped from $26 to $19 during the same period. Investors who panicked and sold during those drawdowns locked in losses and missed the subsequent rally. Holding physical metals requires conviction rooted in structural analysis, not emotional reactions to short-term volatility. You're not trading gold for quick gains. You're positioning capital for long-term preservation against monetary uncertainty. Now let's address the scenario modeling that matters for forward-looking allocation decisions. Bullish case assumes continued fiscal expansion, persistent inflation above 3%, negative real yields, and accelerating central bank accumulation. In this scenario, gold could reach $4,000 to $5,000 per ounce within 5 to 7 years as investors reprieve it against a debasing dollar. Silver could reach $60 to $80 per ounce as industrial demand from solar, electric vehicles, and electronics compounds with monetary demand. This scenario doesn't require dollar collapse or hyperinflation. It simply requires the continuation of current fiscal and monetary trends without major policy reversals. Probability assigned to this scenario might be 40% based on historical patterns of debt-driven economies and central bank behavior. Bearish case assumes the Federal Reserve successfully engineers disinflation, real yields turn positive and sustained above 2%, fiscal consolidation reduces deficits, and geopolitical tensions ease. In this scenario, gold could consolidate between $2,500 and $2,800 for years as opportunity cost rises and investors rotate back into yielding assets. Silver could pull back to $25 to $28 as speculative froth dissipates. This scenario requires significant political will to cut spending, raise taxes, or both, plus credible central bank commitment to restrictive policy, despite recession risks. Probability assigned to this scenario might be 25% given political and structural constraints. Neutral case assumes gold and silver trade sideways to modestly higher, oscillating between current levels and incremental gains as macro cross-currents balance. Gold ranges between $2,700 and $3,200. Silver ranges between $30 and $38. This scenario reflects ongoing uncertainty without clear resolution in either direction. Probability assigned to this scenario might be 35% as markets digest conflicting data and await policy clarity. Notice that none of these scenarios predict exact prices or timing. They assess structural drivers, assign rough probabilities, and allocate capital accordingly. That's how disciplined investors think about asymmetric risk and reward. What about leverage and derivatives in metals markets? Futures contracts, options, and mining equities offer leveraged exposure, but introduce counterparty risk, margin calls, and time decay. Physical metal eliminates those risks, but sacrifices liquidity and leverage. Mining stocks provide operational leverage to metal prices, but carry company-specific risks, including management quality, geopolitical jurisdiction, environmental liabilities, and capital allocation decisions. A balanced approach might allocate 70% to physical metal, 20% to high-quality royalty and streaming companies with diversified portfolios, and 10% to tactical positions in miners with strong balance sheets and low cash costs. This structure captures upside leverage while maintaining core physical holdings that can't be diluted, bankrupted, or confiscated through financial engineering. Let's also discuss liquidity and exit strategy. Physical gold and silver are globally liquid assets with transparent spot pricing and narrow bid-ask spreads at reputable dealers. You can sell gold or silver in any major city within hours and receive cash or wire transfer within days. Compare that to real estate, which might take months to sell, or private equity, which might lock capital for years. Metals providers provide optionality without sacrificing liquidity, which is valuable during crises when capital needs to move quickly. But liquidity depends on form and size. 1-ounce gold coins and 10-ounce silver bars are highly liquid. 400-ounce gold bars and 1,000-ounce silver bars trade at institutional scale with lower premiums, but require larger capital and specialized dealers. Numismatic coins, rare collectibles, and high premium products sacrifice liquidity for aesthetic or scarcity value, which may or may not appreciate independently of spot prices. For wealth preservation and macro positioning, stick to bullion products with minimal premiums over spot. Save collectibles for discretionary hobbies, not core allocation strategy. Storage and security also matter. Home storage eliminates counterparty risk, but introduces theft and disaster risk. Allocated vault storage with reputable providers like Brinks or Loomis provides insurance, auditing, and segregation, but adds annual fees of roughly 50 to 100 basis points. Unallocated storage is cheaper, but introduces counterparty risk because you don't own specific bars, just a claim on the vault's inventory. Bank safety deposit boxes are convenient but lack insurance for precious metals and can be seized under civil asset forfeiture laws in extreme scenarios. There's no perfect solution. Diversify storage across methods and jurisdictions to mitigate concentration risk. Now let's return to the broader question. Is the dollar officially dead? No. The dollar remains the world's primary reserve currency, the dominant medium for international trade invoicing, and the deepest, most liquid financial market globally. Roughly 60% of global foreign exchange reserves are still held in dollars. Roughly 88% of foreign exchange transactions involve the dollar on one side of the trade. SWIFT international payments remain predominantly dollar-denominated, but dominance isn't permanence. The British pound was the world's reserve currency for over a century before losing that status to the dollar after World War II. Reserve currency transitions happen slowly, then suddenly, driven by fiscal unsustainability, geopolitical realignment, and loss of credibility. What we're witnessing now isn't dollar death, it's dollar erosion. Central banks diversifying reserves into gold, yuan, and euros. Trade agreements bypassing dollar settlement through bilateral currency swaps. Commodity producers negotiating contracts in non-dollar currencies. These trends don't destroy the dollar overnight, but they gradually reduce its monopoly and increase fragility. Gold rising from 1800 to 2900 reflects that erosion. If gold reaches 5,000, it won't mean the dollar disappeared. It will mean the dollar lost another 30 to 40% of its purchasing power relative to scarce hard assets, continuing a trend that's been underway since 1971 when the gold standard was abandoned. Since then, the dollar has lost over 98% of its value measured in gold. A dollar in 1971 bought 1/35th of an ounce of gold. Today, it buys 1/2900th of an ounce. That's not dollar death. That's slow, persistent debasement punctuated by periods of rapid repricing during crises. The question isn't whether the dollar will survive. It will. The question is how much purchasing power it will retain, and whether your portfolio is positioned to preserve wealth through that process. Gold and silver don't make you rich. They keep you from getting poor when monetary policy prioritizes short-term political expediency over long-term currency stability. So, what should you do with this information? First, assess your current allocation. If you hold zero metals exposure and significant cash or bond positions yielding less than inflation, consider whether that allocation matches your risk tolerance given current macro conditions. Second, think in decades, not quarters. Metals are long-term strategic holdings, not short-term trades. Volatility is noise. Structural trends are signal. Third, avoid leverage and complexity. Physical metal is simple, transparent, and battle-tested across centuries. Exotic derivatives and speculative mining juniors introduce risks that outweigh potential rewards for most investors. Fourth, stay informed but not reactive. Follow inflation data, central bank policy, fiscal trends, and geopolitical developments. Adjust allocation gradually based on changing conditions, not headlines. Fifth, integrate metals into a diversified portfolio that includes productive assets like equities, real estate, and businesses. Metals are insurance and optionality, not your entire strategy. The gold and silver market right now reflects structural imbalances that have been building for decades. Rising prices aren't irrational exuberance. They're rational responses to monetary expansion, fiscal deficits, negative real yields, and geopolitical uncertainty. Whether gold reaches 5,000 depends on whether those imbalances resolve or intensify. History suggests they intensify until forced resolution through crisis, restructuring, or reform. Positioning for that outcome doesn't require pessimism or paranoia. It requires clear-eyed assessment of incentives, constraints, and probabilities. Governments with unsustainable debt burdens and politically sensitive populations have strong incentives to inflate away obligations rather than default or impose austerity. Central banks have limited tools to fight that inflation without triggering recessions that become politically unacceptable. That creates a structural bias toward higher nominal gold and silver prices over time, punctuated by corrections and consolidations that shake out weak hands. If you understand that framework, you can hold through volatility and benefit from long-term repricing. If you don't, you'll sell at the bottom and buy at the top, chasing momentum instead of following structure. The difference between those two approaches determines whether metals enhance your wealth or drain it through poor timing and emotional decisions. I want to hear what you think about this analysis. Do you agree that current gold and silver prices reflect structural forces rather than speculative bubbles? What allocation percentage makes sense for your portfolio given your time horizon and risk tolerance? Drop your thoughts in the comments and let's discuss different perspectives on positioning for the next phase of this cycle. And if you found this breakdown valuable, make sure you're subscribed and hit the bell icon so you catch the next analysis. Hit the like button to support the channel and help other investors find this content.